afternoon, good evening, wherever you're watching me today. My name is Peter. Welcome back to Invest with Peter. So today I'm going to be talking about why you shouldn't sell your stock at this point. Well, I'm going to be talking about the reason why. I'm going to be talking about the UK economy recession and why UK is playing with fire. And I'm going to be telling you as well the stocks I will recommend. Though I'm not your financial advisor, I just come on YouTube to tell you my opinion, to tell you how I feel, to tell you what I'm doing at the moment and all that stuff. I am not a financial advisor. Anything I say today or any stock I recommend does not mean you should buy or sell anything. Please contact or seek your financial advisor before you do buy anything. Thank you very much. So now let's go to the point, right? Today, I think, the difference between UK and US, there's a big gap between UK and US, the way we run things over here and the way US run things over there, right? UK economy is different from US economy. You see, in US, the government, US go to the feds, right, to do whatever they do or whatever they want to do to bring down the inflation and all that stuff, right? But in UK, it's a different thing. It's a different ballgame. In UK, well, the Central Bank of England, they're just probably there for, I won't say they're just there for being there, but they don't have the autonomous power to control the inflation. The government over here will tell you, well, this is what we're doing. Even before the Fed chairman or the central bank governor will understand anything, it's probably going to see the first on the TV. So they decided in parliament what they want for the economy, how they want to fight the inflation and all that stuff, right? So now the prime minister, the chancellor, they decided that, well, to help UK economy, we need to cut tax, right? They're cutting tax, they're removing stamp duty and all that stuff. But the system or the process they're putting in place now only helps, the people, the 1%. That's what I would call them. So anybody earning over 150,000 a year benefit more in the tax cut that they've proposed, right? So how is that going to really bring down the inflation that we're talking about? Because the people that feel the inflation more are the middle class and the lower class, right? So the proposal they put in front now, it's not going to help anybody. It's probably going to destroy the economy at this point. That is not the way to go by fighting inflation. So what I think about this, because at some point, something is going to break, right? Something is going to break at some point. And that's why you see pound sterling drop drastically against US dollar. This has never happened. Pound sterling is now 1.10, 1.10, to a dollar. That is very bad. I think it's never happened since, for like 37 years now. So that's how bad it is at the moment. Since 1985, pounds has not been this low since 1985. Think about that. So what are they doing? I don't know what. If you look at the pounds chart, right, you see how drastically it went down when the proposal was publicized on Friday. It was just too dramatic, right? So that's why it's not going to help anybody. But don't let me waste your time, right? Let's go to the real, nitty and gritty of today's video, right? So today I'm going to be talking about why you don't have to sell or panic sell at this point. Well, Dow Jones was down, broke the June low last week, Friday. And, likewise, the S&P, only the Nasdaq was parity with the June lows, right? So now the question now is, are we going lower from here, right? I was telling a friend, I said, I think we might probably be going lower, but there's something we need to be looking at, and that is what I'm going to tell you today, right? Market sentiment is very bearish at this point, and that's where you see some analysts, everybody's, saying different things. They will say, well, we have the deep buyers, right? We have the people that will say, oh, cash up now, cash older, cash is king. And you have people that will say, well, market is going down 70 pence. Those are the doom, sayers, right? That's what I call them. But if you look at it, right, if you've been buying the dip since it started going down, Nasdaq has gone down 29% this year. If you've been buying the dip, right, you'll probably be in red at this point, right? Well, I don't mean buying the dip is wrong, but notwithstanding, buying the dip is probably a good, system to use. I buy the dip at dollar cost average every time. So, but what I'm saying is we need to understand where we're at this moment. If you're listening to the doomsayers, like we're going down 70%, we're going down 40%, you're probably going to be folding your hand and be watching at this point, which is not going to help. But the only caveat for us to understand whether we're going lower or market is going to fall, lower than where we are, is this company I'm going to be talking about today. And this company is actually Apple. Apple is either one of the biggest. I think Apple is the biggest company in the whole world, right? Because Apple's got $2.4 trillion market cap, right? But before I go in, I want to let you watch this video and you understand what I'm talking about.
Was typical after this kind of a long-term downtrend. Now, the Nasdaq 100 or composite have been leaders to the downside here. And, you see some major stocks this week, Microsoft, Alphabet, undercut the lows that they had hit back in June. So it clearly seems like there's some headwinds there. Is there a different story with the Nasdaq, or is it essentially the same story, but I guess just more so?
Well, it is. It is exhibiting downside leadership, and that's really coming from the mega caps. And we had cited a couple weeks ago the breakdown in NVIDIA as being a bad example for the rest of them. And now we have Google, we have our Alphabet and Microsoft. Meta has already broken down. So these breakdowns are becoming very widespread below the summertime lows. And unfortunately, what it indicates is that the major indices are likely to do the same. And unfortunately, also the high growth stocks that I think a lot of investors have put some hope into in suggesting that perhaps they had found their bottom. I think, unfortunately, they're going to be surprised to the downside here, with those likely to follow suit, especially if we see heavyweight Apple break down. The level I'm watching on Apple is around 150. If it is taken out, I think that's where we're going to see that real sentiment shift. Already the VIX is poking above a minor resistance level and has room to 35. And if we see Apple break, I think we'll see that level.
All right, guys, just as you've seen and just as you've had the lady, I think at this point, if Apple breaks 150, 149, let's say 149, once Apple breaks 149, I think then we should be thinking like, well, there's fire on the mountain then. But at this point, I think we shouldn't be panic selling, because Apple has got 7% of S&P 500. So a company as big as that, if a company as big as that go under the bus, then the whole thing is going to bust, right? 70% is a big part of S&P. So for Apple to break the support at this point is going to be crisis. So that's what I'm looking at. That's what I'm watching. I don't all the CNBC news or that. I watch them sometimes, but I don't use them as some reason to buy or to panic or to sell or something like that. I watch them like, all right, I understand what this analyst is saying, but what I'm actually watching is Apple chart, right? I put the chart there and I look at it. The support is 150, 149. Once we break 140, 149, which I think we might, I'm not promising we won't, but I think we might break that support. If we do, then that is when I'll be looking at, well, these companies I'm going to be proposing today, right? The companies I'm going to be proposing today are three sectors, which are called the defensive sectors. But notwithstanding, I'm still not going to overlook tech sectors, right? So the tech sectors I'm going to be looking at is Apple. I'm going to be buying more Apple. So now there's blood on the street. People are not recommending, stocks or cryptocurrency anymore. So people are being careful what they recommend. Well, I'm not recommending. I'm just suggesting where I'm going to be buying, what I'm going to be doing. So I'm going to be looking at Apple. I'm going to be looking at Salesforce CRM. I'm going to be looking at Microsoft and Adobe. These are the four tech companies I'm going to be looking at. Once Apple breaks that support, these are the companies I'm going to be doubling up. I'm going to be doubling into these companies, right? So, and also that's the tech sector. Let's go to the energy. We cannot overlook energy sector at this point, regardless of what's happening. We cannot overlook energy sector just because of what's going on in Europe at this point and all that stuff. So I cannot overemphasize that. So I'll be looking at Chevron. I'll be looking at LNG, Devon. I'll be looking at Occidental Petroleum, and I'll be looking at BP. So these are the five companies, energy companies that I'll be looking at around energy sector, right? Because, once we break that support, then it's going to be bloody, right? It's going to be bloody, guys. I'm telling you, it's going to be bloody. I don't know where this support is going to be at this point, because market is not looking good at this point. I'll be sincere to you. So now the last sector I'll be looking at is the health sector, which everybody knows as the defensive, because regardless of what happens, people still going to need the clinic, people still going to call their doctor, people still going to take medication. See, health sector as a defensive sector. So the companies I'm going to be looking at J&J Healthcare Company. Yeah, I'll say company because people say, yes, healthcare. Well, I'll say it's the largest healthcare company out there with $450 billion in market cap. So I'm going to be looking at that, and it's also a dividend stock as well. So as I invest in there, I'll be getting dividend as well. So if you want to look at that, so the second one is Lilly, Lilly. So with 291 billion market cap, I was looking at, okay, what's the turnover in 5 years, and turnover in 5 years is 32%. So that would do me, because we don't know if we go into recession, when we're going to recover from that. So I'll take 32% any day, anytime at this point. So the third one is UNH, that is United Earth Group. So with market cap of 500 billion market cap, sorry, with 5 year return is 23.7%. So I'll take that all day long. All these companies I'm recommending are dividend. They still give you dividend even as you invest in them. So my advice today is, guys, we need to be looking at that support level for Apple, because it's the largest in S&P. So once that support is broken, then we need to shift our goalpost and go defensive, right? We need to go defensive once that's broken, because that means we still have some flaws to fill in. So to play safe, I'll be going to these defensive companies, and that'll be it, guys. So guys, that's it for today. I don't want to waste your time or hold you any longer. My name is Peter. Please subscribe to the channel and help the channel to go. I'll see you in the next one. Bye for now.